Welcome to today's Explainer, where we're digging into a really fascinating classic buy-side investment memo. Today, we're putting MSCI Incorporated under the microscope, and we're going to answer one critical, overarching question. Is a genuinely great company always a great stock?
Okay, let's dive right into this massive figure on the screen, $21 trillion. Let that sink in for a second. That is the amount of global assets benchmarked to MSCI's equity indexes. With that kind of unbelievable reach, MSCI is essentially the invisible plumbing of the entire global financial world. They provide the ultimate measuring stick that the whole investment ecosystem uses to gauge success. But as we're going to see today, commanding that much influence doesn't automatically mean their stock is a flawless buy.
So here's our agenda. First up, the trillion-dollar benchmark giant. Second, building the index moat. Third, we'll compare the engine versus the adjacencies. Fourth, we'll uncover some hidden risks and red flags. And finally, we'll wrap up with the final investment verdict. Let's get right to it.
Section 1, the trillion-dollar benchmark giant. We're tracing the roots of a literal financial monopoly. To really understand why this company commands such a huge premium in the market right now, we need to spend just a few seconds looking at how they built their intellectual property over the decades.
As you can see on this timeline, MSCI definitely isn't the new kid on the block. They pioneered global indexing way back in 1969. Then they completely entrenched themselves in the market after their 2007 IPO, using that public capital to just continuously compound their growth. But I want you to look at the right side of this timeline. From 2021 to 2026, they've been frantically buying up adjacent data companies, pushing hard into private assets and AI tools, basically trying to surround their core benchmark IP. The real question is, are these new add-ons actually as good as the original product?
Well, to answer that, we first have to understand the original product. Let's look at Section 2, Building the Index Moat, the sheer power of institutional habit. Now, what's so fascinating here is how this explains the absolute stickiness of MSCI's core product. The memo highlights this concept called benchmark entrenchment. Essentially, asset managers have zero incentive to switch providers. Why? Because the entire ecosystem, the asset owners, the consultants, the managers, they've all built their daily institutional habits around MSCI benchmarks. If everybody else is speaking MSCI, you have to speak it too. I mean, that leads to an incredible 96.9% retention rate in their index business. They are basically irreplaceable in that space.
But here is exactly where the story gets a little complicated. Section 3, the engine versus the adjacencies. It's a tale of two completely different businesses. Yes, management has done a brilliant job compounding revenue over the years, but our memo clearly separates their highly profitable core engine from those newer, riskier acquisitions we just talked about. If you look at the breakdown here for their 2025 total run rate, that legacy index business is still the undisputed heavyweight, driving 57% of the firm. Analytics makes up 23%, while their newer pushes into sustainability and private assets make up the rest. So the crucial takeaway here is that this is not some generic high-growth software story. At its heart, it is fundamentally a benchmark IP model with a few extra add-ons bolted to the side. And wow, this really illustrates the divide between those businesses. Looking at these early 2026 adjusted EBITDA margins, the index segment's profitability absolutely dwarfs the rest of the company. It operates at an elite margin north of 75%. Meanwhile, that newer private assets division recently plunged down to roughly 19%. So you have a core engine that's an absolute cash machine and adjacencies that are really struggling to prove their worth. Which leads us directly to this vital takeaway from the memo. The marginal dollar of future growth is lower quality than the legacy dollar of earnings. Basically, while MSCI's legacy strengths are truly world-class, their future growth heavily relies on these lower-margin, highly competitive side businesses that just haven't proven their economic power yet.
And you know, that lower quality growth isn't the only concern. Section 4, Hidden Risks and Red Flags, what the bull case ignores. Let's see how this fits into our skeptical framework, because there are some serious vulnerabilities hiding right behind that premium stock valuation. While their operations print cash, they're facing some very real headwinds. First up, heavy customer concentration. BlackRock alone drives about 11% of their entire revenue. Second, they have cyclical fee structures that are linked directly to market performance. Third, as we saw, margins and retention are visibly weaker in their new businesses. And perhaps most surprisingly, management themselves are warning that AI and cloud computing could actually lower the barriers to entry for competitors, making self-indexing a real threat. Add in all the technical debt from their rapid acquisition spree, and the picture definitely gets a lot blurrier.
So, keeping those risks in the back of our minds, let's look at the price tag. When we stack up the valuations here, you can see MSCI is trading at a super rich 33 times earnings. Now, compare that to S&P Global sitting at a 26 multiple. It is incredibly hard to justify that kind of premium for MSCI when you factor in their heavy reliance on BlackRock and the fact that their new growth engines are actively dragging down overall margins. The market is basically pricing this stock for absolute perfection.
And this creates a really fascinating contrast in how the company is being run. On one hand, you have pure operating brilliance. The core business is highly cash generative, and their retention is world-class. The management team are undeniably great operators. But on the exact opposite hand, you have major capital allocation concerns. Recently, management has been doing debt-funded stock repurchases. That means they are literally borrowing money to buy back their own stock at near-peak valuations. That's a highly aggressive rather than conservative financial strategy. So let's pull all of this together. We have an elite core business, struggling new divisions, some very real risks, and a sky-high valuation paired with aggressive financial engineering. Section 5, the final investment verdict. It's high quality, sure, but is it a high conviction buy? Let's synthesize what we've learned.
The report fundamentally concludes with this exact thought. MSCI is a great core business and only a good consolidated business. Ultimately, it just doesn't clear a skeptical buy-side bar as an investment today. The benchmark franchise is exceptional, absolutely, but the overall company is heavily burdened by those weaker adjacent segments and a valuation that leaves literally zero room for error.
So what would it actually take to flip this to a buy? First, we'd need to see a massive price drop to create a much safer margin of safety. Second, we need hard proof that their expensive private asset acquisitions are lifting margins, rather than just dragging them down. Third, we definitely want to see a more conservative approach to their balance sheet, meaning far fewer debt-funded buybacks. And finally, we need to see some real moderation in that heavy BlackRock concentration risk.
Make no mistake, MSCI is a phenomenal watchlist name. There is absolutely no denying the power of their core moat, but the memo leaves us with the ultimate question for any curious investor. Are you willing to overpay for yesterday's moat when tomorrow's growth looks vastly different? Think about that the next time you're evaluating a premium market leader. Thanks so much for joining me on this explainer, and remember to keep asking the tough questions.